All right, I got a question for you. Where do bank deposits come from? Did you ever think about that? Where deposits come from? You probably didn't. You probably just think, oh, I got a check from my job. I put it in my account. I got a bank deposit. There you go. Where did the employer get the money? Oh, well, he sold some stuff. He might. Bank deposits can only come from two places. They can come from the government, or they can come when banks make loans. All right. The government side, probably most of you could understand that. You get a Social Security check, or if you're a vendor to the government, or if you're an employee, you get a check, and you deposit that in your account, and boom, there's a bank deposit. All right. When a bank makes a loan, let's talk about lending, for example. Bank makes a loan. You go into a bank, you ask for a loan. All right. Now, the loan officer, he's not, people think like, oh, you got to have the banks lend out the reserves. They don't lend out the reserves. And even if they could lend out the reserves don't go anywhere. They stay in the banking system. They might get transferred from, one bank to another, but they don't lend out the reserves. It's not a Jimmy Stewart, It's a Wonderful Life, the Bailey Building and Loan situation. Okay, you go into a bank, you sit down with the loan officer, you ask for a loan. The loan officer is going to evaluate your ability to pay back the loan, your credit worthiness. Okay, he's going to ask you, what's your income? How much debt do you have? You probably look at your credit report. So all of this is the process of determining your credit worthiness. In other words, your ability to pay the loan back. That's the only thing the loan is based on. The loan officer doesn't say, hey, wait a minute, Mike, let me call my reserve desk and see if I got enough reserves down there. No, he's not even connected with the reserve desk. He probably doesn't even know the number to the freaking, I guarantee you, you go into your bank today, ask for a loan, just, fake it. He's not going to pick up the phone and say, hey, Joe, do we got enough reserves here to give this guy a loan? No, it doesn't work. He's going to make the loan regardless of whether or not the bank has enough reserves. He doesn't even know, but he's going to make the loan based on your ability to pay. Now, what happens after that? Because the banks do have to have a certain required amount of reserves, usually 10% for the amount of loans that they make. But let's say they don't. The banks then have a 2-week period. The Fed grants them a 2-week period. Even before that happens, let me backtrack. So the bank makes the loan. Let's say it doesn't have sufficient reserves. What happens? It gets an overdraft at its account at the Fed, based on the needed amount of reserves, which it doesn't have. So it's like if you wrote a check and you get an overdraft, you didn't have enough money in your account, you have an overdraft, and the bank covers the check for you, same thing. All right, the bank makes the loan, it doesn't have enough reserves in its reserve account at the Fed. Fed covers that. It has a 2-week period, then it has a 2-week period to get those reserves. How does it get those reserves? It borrows them, all right? But the Fed has already added the reserves into the banking system by virtue of the fact that it covered the overdraft automatically. It's an automatic overdraft, and then the Fed automatically covers it. So the very act of making that loan creates reserves. And then it also creates a deposit because, boom, you have a checking account with a deposit in it, right? Let's say you took out a loan for 10 grand, personal loan. The next day or the next hour, whenever, once that loan is approved, you go to your checking account. Hey, I got 10 grand in there, right? So that's how it happens. Now, the Fed has to do this. Think about it, because if it didn't do this, if it didn't cover these reserve needs, then what would happen is it would lose control of its target rate, of the Fed funds rate, because there would be fewer and fewer reserves in the banking system to cover this loan creation activity, And then all these banks trying to borrow reserves to cover their requirement would cause the Fed funds rate to go up and up and up and up, ultimately to infinity, right? So the Fed has to. I mean, it's very interesting. The very act of making the loan forces the Fed, in effect, to provide the reserves in order to sustain its policy rate. You see? So that's how it happens. The reserves don't come from outer space and suddenly show up in the banking system. They don't come from China, okay? Dollars can only exist. Dollars on deposit, and that's really all. Electronic dollars can only exist on the books of the Fed. Yeah, there might be dollar bills floating around out there in the rest of the world that people stuff under their mattress, but that's a tiny fraction. By the way, let's break this down. I'll just break it down here at the end of this video, because I had a guy send me an email saying, Mike, you don't know what you're talking about. 99% of all money is bank credit. No, my friend, that's not true. So total bank credit right now is about 12.5 trillion. That's the kind of money that banks create, right? That's credit money. And the monetary base, which is government money, high-powered money, that consists of reserves and Federal Reserve notes, right? Paper dollar bills and coins. That's about 3.7 trillion. So roughly it breaks down the whole thing. Let's call it, 16 trillion. About a quarter of that, 25% of that, is government money, the monetary base. The rest of that is bank credit. Now, there's all different kinds of forms of money. I mean, if you and I engage in barter, you could call, whatever I exchange with you, you can call that money too. But the stuff that we call money really is bank credit and money, bills and coins and reserves. So there you go. That's how it's not 99%. And by the way, it used to be, for years and years and years, for decades, reserves never went over 800 billion. So it was kind of like more of a 90% to 10%. But since the crash, it went up. And by the way, it was much higher. It was over, well over 4 trillion in that monetary base. And bank credit was much lower. It was almost like 40%, 60% in the years following the financial crash in like 2009 and 2010 and 2011. But now that things are kind of normalized, it's like 75% bank credit, 25% government money, monetary base. So there you go. Loans create deposits. Government spending creates deposits. That's where it comes from. Bye.